A trader who had been watching the gold market closely made a big decision this week. He had been holding a short position on gold, meaning he was betting that the price would fall for almost 3 weeks. This morning, he finally closed that trade. The result was a profit of about $2,189. At first, this sounds like a simple win. But the story is more interesting than that. On the very same day the trade was closed, gold prices suddenly jumped higher. Because of this sharp rise, the trader gave back some of his earlier gains. Still, he walked away with a profit, and he followed his own trading rules from start to finish. For him, that discipline mattered just as much as the money. But closing the trade brought up a bigger question. Should he go short on gold again? Should he wait for a new setup? Or is the price about to keep falling just like it did for most of the last 3 weeks? To understand why this trade worked, it helps to look back at how it started. For weeks, gold had been moving downward. The trader believed the trend would continue, so he entered a short position and held on through the ups and downs. It turned out to be a strong and steady trade. But now that it has ended, he has to decide what comes next. Looking at the 4-hour chart, he sees something important. There is a level of resistance nearby, a price point where gold has struggled to rise past before. He is watching this level closely. He wants to see how the market behaves around it before making his next move. If he does decide to enter a new short position, he plans to share the update with members of his private trading group first. There's also a technical detail worth noting. On the chart, there's a spot where old support has now turned into possible resistance. This means the price may have already reached a point where it is likely to turn back down. However, the trader admits there is a chance he closed his trade too early. Markets can be unpredictable, and even experienced traders sometimes exit a position before the full move happens. He says this would not be the first time it has happened to him, and it likely will not be the last. Even so, he still believes this resistance level will probably hold, but he also points out that there are other price levels on the chart that he actually likes more. These levels may offer a better balance between risk and reward. If he does open a new trade, he plans to use a smaller position size this time. His reasoning is simple. The recent pullback in price has been narrow and quick, not a strong, confident bounce like the market has shown in the past. A weaker bounce usually means a weaker signal, so caution makes sense here. He compares this current setup to an earlier one, where gold had a much bigger and more convincing rally. That kind of strong bounce excited buyers and gave sellers a clear, high-quality chance to fade the rally. This time, the setup looks different, and that difference is shaping how carefully he plans his next step. Before making any final decision, though, the trader says it is important to look beyond just the charts. Economic data and larger market forces also play a role. Recent numbers on manufacturing and consumer confidence have shifted slightly, and these changes could affect how gold and the US dollar move in the days ahead. Before making his next move, the trader always follows one important rule. He never trades on gut feeling alone. Instead, he checks the data first. This habit is what separates a careful trader from someone who is just guessing. And this week, the data told an interesting story. Early this morning, fresh manufacturing numbers came out in the United States. They were weaker than expected. On their own, weak manufacturing numbers usually put a bit of pressure on the US dollar. A softer dollar often means gold can rise, since the two tend to move in opposite directions. That is one small piece of the puzzle. But the picture did not stop there. The day before, consumer confidence numbers were released, and they also came in a little below expectations. This added more softness to the overall economic outlook. However, not everything pointed in the same direction. Job openings data, known as the JOLTS report, actually came in strong. This mix of results, some weak, some strong, is exactly why relying on just one number can be risky. A trader who only looked at manufacturing data might feel very different than one who also considered the strong jobs report. Because of this mixed data, the trader explains that his overall view is still leaning bearish on gold. In simple words, he still believes gold is more likely to fall than rise in the bigger picture. At the same time, he admits his confidence in that view has softened slightly compared to a few days ago. Markets rarely give perfectly clean signals, and this week is a good example of that. Now let's talk about the charts, since this is where many viewers get the clearest picture. On the 4-hour chart, the overall downward trend still looks strong to the trader. Prices have been sliding lower for weeks, and nothing on the shorter time frame has broken that pattern yet. But zooming out to the daily chart tells a slightly different story. On this bigger picture, there is room for gold to rise a little more before facing strong resistance again. Moving averages, which are simply lines that track the average price over a certain number of days, show that gold still has space to climb toward levels like the 20-day or 50-day average. Even with this possible bounce, the trader still sees the bigger trend as pointing downward over time. He also highlights two specific price zones that catch his attention. One is around the 4,125 level, and the other is near 4,200. Both of these areas could become spots where sellers step back in, according to his analysis. These are not random numbers. They come from a mix of past price behavior, resistance zones, and technical tools he trusts. One tool that stands out in his process is something called a Fibonacci retracement. In simple terms, this is a method traders use to measure how far a price might pull back before continuing its original trend. He points out that the 61.8% retracement level lines up closely with an important resistance zone, and interestingly, it also lines up near the round number of 4,200 an ounce. When multiple signals line up like this, it often catches the attention of many traders watching the same chart. He also mentions trend lines, which are simply straight lines drawn across price highs or lows to show a pattern. While he does not build his entire strategy around trend lines alone, he still finds them useful, especially when they are easy for many traders to spot. When trend lines, Fibonacci levels, and resistance zones all come together in one area, it creates what many traders call a high confidence setup. All of this sets up an important question. If gold does rise into one of these zones, will it turn back down as expected? Or will this time be different? That question leads directly into the deeper consequences this shift could bring, both for the trader and for the wider financial market. When a market like gold starts to shift, the effects rarely stay in one place. A change in gold prices can ripple out into currencies, interest rate expectations, and even everyday decisions made by people who have never traded a single dollar. This part looks at why these small chart movements actually matter to a much wider audience. Let's start with the US dollar, since it is closely tied to gold. This week, several central bank leaders spoke publicly, and their words carried weight. One key figure focused on two main ideas. First, he stressed the importance of controlling inflation. Second, he reminded everyone that the central bank values its independence, meaning it makes decisions based on data, not outside pressure. These 2 points may sound simple, but they carry real influence. When a central bank leader sounds firm and focused on fighting inflation, it often signals that interest rates may stay higher for longer. Higher rates tend to support a stronger dollar, and a stronger dollar often puts downward pressure on gold. This is where the connection becomes important for everyday people, not just traders. A stronger dollar can affect how much imported goods cost. It can influence how affordable international travel feels. It can even play a role in how much interest people pay on loans, since dollar strength and interest rate expectations often move together. So while this may look like a story about gold charts, it is really a story about the wider economy. At the same time, not every signal pointed in the same direction. Other central bank leaders, speaking at the same event, offered a different tone. One official suggested that policy already felt tight enough, hinting that further pressure might not be needed. Another central bank pointed to concerns about a slowing economy, especially due to ongoing trade tensions. This shows that even among major financial decision makers, there is no single shared opinion. Some see more room for caution, while others feel the fight against inflation is not finished yet. This kind of disagreement matters because markets do not like uncertainty. When central bankers send mixed signals, traders and investors have to work harder to figure out what might happen next. That uncertainty can lead to sharp price swings, like the one seen in gold this week, where prices rose quickly right after a long downward trend. There's also a social and psychological side to this story. Many people see gold as a symbol of safety during uncertain times. When economic data becomes mixed and central banks send unclear signals, some investors turn to gold simply because it feels stable, even if the numbers do not always support that feeling. This is why gold can sometimes rise even when the broader data leans in the opposite direction. Human behavior, not just economic logic, plays a real role in these price movements. For traders like the one in this story, these mixed signals create both risk and opportunity. A trader who reacts too quickly to one piece of news might make a decision that does not hold up once more data arrives. This is exactly why he emphasized smaller position sizes going forward. Instead of betting big on one clear direction, he is adjusting to a market that currently feels less predictable than it did a few weeks ago. From a balance perspective, it is worth noting that both outcomes remain possible. Gold could continue rising if the dollar weakens further and uncertainty grows, or it could resume its downward trend if strong economic data returns and central banks maintain a firm, inflation-focused stance. Neither outcome is guaranteed. That is exactly why careful analysis, not guessing, remains so important in moments like this. As this story comes to a close, the bigger question still remains unanswered. Was closing this gold trade the right decision, or was it a move made just a little too early? Only time, and the next few days of price action, will truly tell. For now, the trader has made his position clear. He is watching two key zones on the gold chart, one near 4,125 and another closer to 4,200. If price rises into either of these areas, he may consider stepping back in with a new short position. But he has also been honest about one thing. This time, he plans to trade smaller. The recent bounce in price has not shown the same strength as previous rallies, and that difference matters to how much risk he's willing to take. This raises an interesting question for viewers to think about. And when a trade has already delivered a solid profit, how much risk should someone take on the next one? Is it better to chase the same size and confidence as before, or does it make more sense to slow down and trade smaller until the market gives a clearer signal? These are the kinds of decisions traders face every single day, and there's rarely one perfect answer. Looking ahead, several things could shape what happens next. Economic data will continue to play a major role. If future reports on manufacturing, consumer confidence, or job numbers come in stronger than expected, the US dollar could regain strength, which may pull gold back downward. On the other hand, if data continues to disappoint, the dollar could weaken further, giving gold more room to climb. Central bank commentary will also remain important. Markets are still processing recent remarks from global financial leaders, and any new statements in the coming days could shift expectations quickly. A single sentence from a central banker can sometimes move markets more than an entire week of economic data. This is why staying updated rather than reacting to just one headline remains so valuable. For viewers who want to follow along, there are simple habits that can help. Watching how gold reacts near key resistance levels, paying attention to major economic data releases, and following updates from trusted financial sources can all help build a clearer picture over time. Nobody needs to predict the market perfectly. Instead, learning to recognize patterns, stay patient, and manage risk wisely is often what separates long-term success from short-term luck. It's also worth remembering that no single trade defines a trader's success. This trader closed a profitable position, gave back some gains during a sudden rally, and is now carefully deciding his next step. That is simply what disciplined trading looks like in real life. It is not about being right every single time. It is about following a consistent process, managing risk, and adjusting when new information arrives. So, here's a question worth sitting with. If gold does rally into one of these resistance zones in the coming days, would you expect the trend to reverse, or could this be the start of something bigger? There is no wrong answer, only different perspectives shaped by different experiences and outlooks. As this story continues to develop, one thing remains certain. Markets rarely move in a straight line, and gold's next chapter is still being written in real time. For those who want to stay ahead of these shifts, following reliable updates and understanding both the technical and economic sides of the story will always be more valuable than reacting to headlines alone. That brings today's story to a close. Gold's next move remains uncertain, but one thing is clear. Patience, discipline, and careful analysis will continue to matter more than ever in the days ahead. This has been Golden Crest Finance. Stay informed, stay patient, and stay ready for whatever the markets bring next.